I just wanted to kick off this panel with a few remarks. Its title is Regulation Working After Lehman? And of course, this is all to do with the response globally, and as our financial secretary has just pointed out, locally, up to the biggest financial crisis after the Great Depression of the 1930s. There's no doubt about that. It was the biggest. But also, even more significantly, it was the most complex financial crisis. And possibly one thing that it revealed, which is possibly the most serious sort of diagnosis of the crisis, or symptom even, was that no one really knew what was going on in a globalized financial system, which is quite remarkable given how many people prior to the crisis claimed that they did know what was going on. And arguably, and we can discuss this in the panel as we get going, arguably, we still don't. The Financial Stability Board, which is one of the bodies, as many of you will know, that's sort of in the middle of the reform effort, recently reported, I think it was only last week, that 5 years on from the crisis, financial firms haven't really got to grip with counterparty risk, which is, again, a remarkable statement, given that uncertainty and lack of knowledge about your counterparties was at the heart of the collapse of Lehman and AIG. Now, after the financial crisis, there was a big meeting. In fact, there were quite a few big meetings. There was a very big meeting in Pittsburgh of the G20 leaders. And the whole idea of that meeting was to effectively work out how do you fireproof the financial system so this doesn't happen again. And there were a number of projects that were launched at that meeting. One was about bank capital and reduction of leverage in the system. Another was about modifications to the pay of bankers to discourage what the G20 leaders then said was the linkage between pay and excessive risk-taking. Another was about the obscure but enormous world of derivatives trading. And finally, there was the project around too big to fail to move towards the resolution of failing financial institutions rather than taxpayer-funded bailouts. But where are we now 5 years down the track? The too big to fail project is still work in progress 5 years down the track. Derivatives reform has been enacted through laws in various jurisdictions, but it's caught up in some quite severe disputes between countries and between regions around the extraterritorial export of rules to other, from one place to another. Bank capital, well, that project is pretty much complete and will be implemented over the next few years, but there are worries that some of the bank capital rules have been watered down a little bit. And there are also a whole heap of conflicting or different local reforms in various jurisdictions, ranging from aspects of Dodd-Frank, like the Volcker rule, or ring fencing of banks in Europe. Now, in Asia, I think our chairman, Carl Sontong, alluded to this in his opening statement. In Asia, what's the position? Well, there were no bailouts. Now, that's not a statement which one can be complacent about, but the fact is there were no bailouts. That meant that the political narrative resulting from the crisis was different, obviously. We have possibly in other parts, all over Asia, different political priorities depending on the state of development and growth in different countries. We have a problem, in my view, about tackling the export of what has been termed in both the European Union and the US, their policy preferences to Asia on the back of the fact that their firms, their financial firms, are big players in this region. Now, these are just impressions around where we're at after 5 years. Now, our panel, I think one would often say we're privileged to have a panel of this degree of expertise, but actually we are very privileged to have a panel like this. We have here not only leading global regulators, and we have a leading academic who are all in the thick of this, right in the thick of it. We have Greg Medcraft, who is the chair of ASIC, the Australian Securities Regulator, and for his sins spent 30 years as a securitization investment banker. So he's been on both sides of the fence. We have Ranjit Singh, who's the chair of the Malaysian Securities Commission. He's also vice chairman of IOSCO, IOSCO being the global club of securities regulators as a sort of counterpart to the Basel Committee for the banking world. And he's also chair of the Growth and Emerging Markets Committee of IOSCO. Next to Ranjit, David Wright, who is the Secretary General of IOSCO. And finally, Douglas Arner, who's the head of the Department of Law at Hong Kong University. So that is a really, really stellar panel. And you will not get, I think, a group of people who know more about this subject than this group. So we'll see where we get to by, I think we finished at something like 10:40. We'll see where we get to at that point and see if we get an answer to the question of is regulation working 5 years after Lehman. Now, the first question I'm going to kick off with, and I want to put this firstly to Greg and then to David, is this, and it's a pretty obvious one, it didn't take me long to think of it, is will the G20 reforms, Basel III, OTC derivatives, reducing reliance on credit rating agencies, there's a whole panoply, and I mentioned some earlier on, but will they really, really make the system safer to withstand the next crisis? And thoughts around that question include, have the reforms, or will they come at an unacceptable cost to growth? Do some conflict with national self-interests? And as I think both the Financial Secretary and Carlson Tong referred to, is there a problem with over-regulation? And is there a necessary complexity? Some time ago, one of the Bank of England, I think deputy governors, talked about the Tower of Basel in terms of complexity in bank regulation. So the question is, will all this really make the system safer? So can I pass over to Greg first?
Sure. Well, look, I think this crisis has probably been like every other crisis in history that generally, you basically are shaped by crisis, unfortunately. And if you look at the history of crises, basically, normally crises happen when usually innovation exceeds or outstrips the ability to regulate it. And I think the last crisis was yet another example of that. And also a lack of understanding of the impact of globalization. So, I think the reactions to what's happened, we've dealt with what happened in that last crisis. When we think about it, we dealt with the too big to fail issue. We are dealing with it. Systemic risk is now something I think is front and center for, whether it be insurance, banking, or securities regulators. The Basel, as you mentioned, the capital and liquidity ratios, looking at resilience of that sector, the OTC derivatives reforms, shadow banking, at least trying to start addressing there in money market funds and securitization and repo markets, and then credit rating agencies, as you mentioned, Ashley, and remuneration. So, misaligned incentives. So, I think they're all key things that needed to be done to strengthen the resilience of the system. But secondly, I think there is progress remains. I think they still need to deal really effectively with the too big to fail issue, and that is in process. Secondly, shadow banking. As a former investment banker, your creativity is normally you make money where people regulate and you can move outside of it. So, I think shadow banking will continue to be a challenge, because innovation will. We saw with Alibaba's structure in China this week. It's quite fascinating what they're doing now, solving a problem, dealing with providing funding to effectively SMEs through securitization. I think we're going to see more of that online. So, there's that new aspect, and I think shadow banking is one that you're just going to have to, be, and it's largely in what we regulate in markets. So I think there's where it's going to be probably a vigilant approach, but I think, we shouldn't kill innovation. Then I think the other progress where I think we need is international coordination and cooperation, because I think what's come out of this is really the need to really focus on, for regulators to focus on globally on outcomes and look to rely on one another a lot more. And I think that is really a big thing that's front and centre, and it is for securities regulators, and I believe it is for business. In terms of 5 years on, clearly Australia as leading G20 this year, very much the focus will be on 4 things. One is actually completing the resilience reforms, too big to fail, on banking. Secondly, dealing with really defining the global SIFIs and what needs to be done in that area. Completing the derivatives reforms, and then clearly perhaps strengthening what's done around shadow banking. And I think it's very much on, the focus will be, of the G20 Australia will be very much on implementation. Let's finish the work that's started. But I do think the other concern, I think, are issues that we need to be thinking about. Again, I think that what's happened with requiring mandating CCPs, we need to question whether we're actually creating a new global systemic risk. I think that's important. As I said before, I think with some of the rules on OTC derivatives reforms, I think we've got a real danger of fragmentation of markets, and I think clearly that goes against the whole concept of actually encouraging capital flows amongst countries. I think it's important. The other thing I think going forward, I think that needs to be learned is that I do think that before there is a new policy development, I think we need to carefully think about the cost, quantitatively, the cost benefit of what we're going to do to try and avoid unintended consequences. And additionally, I'd say what we need to think about is also the cumulative impact of initiatives. You can't consider these things on their own going forward. So I think they're just some thoughts. And I think the big thing of all of this is, we're dealing with what the known knowns are, and the big issue is it's generally the unknown unknowns that actually are what come to attack you in a crisis. So I think to that extent, really focusing on emerging risks is actually going to be critical if we're going to have, basically have a more resilient global financial system. So, I think it's always that unexpected. And I do think one area that I believe will be the black swan will be something probably out of cyberspace where, it's what we don't know. So.
Thanks. Can I just pass that question over to David?
Well, with pleasure, Ashley, and thank you very much for this invitation to this prestigious forum. Well, we're in year 7 post the beginning of this crisis, so it's a good time to take stock. And I think as we move forward through this year, more and more questions are going to be asked precisely to regulators. Have you done this job? Have you made the system safer, more sustainable? And indeed, as we go towards the Brisbane G20 summit, the chair of the Financial Stability Board wants the big 4 pieces delivered. And that is cross-border resolution frameworks, OTC derivatives, shadow banking, and of course the capital standards. There's one that's missing, in my view, which is corporate governance. I think we underestimate the importance of corporate governance in financial firms, and there's just an eerie correlation between those firms that failed and the types of people who were running them. And it doesn't make sense, does it, to have clerics running banks or people like that. So I think corporate governance, ethics, responsibility, is just becoming increasingly important. So where are we on the big 4 issues that Greg was talking about? The too big to fail cross-border resolution, in my view, is the most difficult and most crucial part of the whole piece of financial reform at the global level. If we can't take failing financial institutions of whatever size and wheel them out to the graveyard like we would a concrete company, then I think we fail to do the job, because the public, governments, will have to bail out in those circumstances. This is absolutely crucial, and I think there's an immense amount of work to do this year to build a solid legal framework, a non-discriminatory legal framework, a framework which we know who's in charge and who will be able to resolve these complex institutions. There's just a long way to go here. So I think this is one of the biggest, and perhaps the biggest test that we have. No doubt there's been progress on bank capital. If you read Paul Tucker's recent paper from the United States, he will claim that the banking capital has gone up by 10 times. One wonders why it was only 10 times less at the beginning of this crisis, but that's good progress, no doubt about it. Still further work to go on the liquidity standards, still further work to harmonize or get much more convergence on the risk weights, which are still very random across firms. On shadow banking, well, I think we've identified most of the problem. But I very much share what Ashley said, that there is an incomplete understanding of the interconnectivity, the contagion channels, the effects of these policies one on another. So we're looking at money market funds, and we have policies, the IOSCO standards, securitization, which under Greg's leadership, we're trying to encourage the development of securitization, good securitization markets, and we're taking an initiative to do that. Repo and securities lending, but who are the non-bank, non-insurance SIFIs? That's going to be a big subject for this year. Is this asset managers or not? Is it hedge funds or not? And those comments are meant to illustrate the fact that we still have, again, a long way to go to put in place a framework here, which not only do we fully understand, but we have the data to support. Today we don't have the full set of data that we require. On derivatives, good progress, but as Ashley was saying, cross-border legal conflicts. And so actually the work that he's chairing for IOSCO to build a framework for dealing with these cross-border disputes becomes very critical. Is this all at an unacceptable cost? Well, I don't think so. I think the world has lost 15% of GDP so far. And when I was sitting in the hotel lobby and watching those people come across from the ferries, those are the people, of course, who suffer in this financial crisis. And if you look at the number of jobs that have been lost, the social hardship, actually you can make it's rather surprising how little social conflict there has been in the world. Might not happen again, and that's why these reforms are so critical. The cross-border resolution, as I said, is absolutely vital, and for me it's perhaps the key piece of all. I personally think that the structural issues, Volcker and all these other approaches, Vickers and Liikanen and so forth, I think they're of secondary importance compared to the too big to fail issues. But there's two other things I want to say. The first is, as we shift the global policy agenda, hopefully we can do the big part of that completion this year, we now move to implementation. Is the world going to implement these standards in a consistent way? Yes or no? And so the work of IOSCO under the chairmanship of Stephen Bardi from ASIC and others takes on increasing importance, because it's no good agreeing standards and not implementing them. So we're shifting here towards implementation. And lastly, we don't have institutions at the global level that have legally binding powers. That has just about worked so far. But in a world in which we're going to have not a few big capital markets, but many capital markets, will everybody play by the rules? What happens if we do disagree? Where is the legal framework to resolve these disputes? So I think we have to think forward 10, 15 years. Well, you're going to have many big capital markets here in Asia. It won't just be the EU and the US. And then what? Are we going to see fragmentation, or are we going to see harmonization and convergence? And if we want that, and I believe most people in this room do want that, we're going to have to think very hard about the institutional framework to guarantee that. Thank you.
Thank you, David. Just a couple of remarks, actually, coming from actually both your and Greg's thoughts. Firstly, whenever David talks about the financial crisis, and I've seen him talk in Europe, he quite rightly always points to the real effects on the real economy and what I would call real people in relation to this. It's so easy in our world to read the Financial Times, The Economist and others and believe that these reforms are largely technical. And of course we hear financial firms telling us that the reforms come at a cost. Well, of course that cost is quite deliberate. But what this is really about is addressing some real effects. And of course in Europe, it's been, particularly Southern Europe, very, very, very acute in places like Spain and others, Portugal, etc. The second point is I think David picked up on something that has possibly been, this is moving into the next question I'm going to pose, has been underplayed, which is the question of, I think you called it corporate governance. I think it's interesting that the reaction to this crisis is all about systemic risk, system stability, which is basically about putting safety nets in place, which is, as I've mentioned, do come at a cost. Whether it's bank capital or whether it's the setting up of clearing houses to make the derivatives world safer. I remember 10 years ago, in my sort of first stint at the SFC, that was just after the dot-com crash or crisis. And then there's Enron and WorldCom, etc. And the subject of the time was all corporate governance, Sarbanes-Oxley, corporate governance codes, etc. It's interesting that in relation to the financial sector and financial firms, the reaction has not been so directed at conduct within firms. It's been directed at erecting the safety nets around the firms themselves. And that really gets into my second question for the panel, which is this. Are the G20 reforms and all the other reforms we've been talking about to address the financial crisis only really tackling the symptoms but not the root causes of the problem in financial markets, which may, I know you say may, lie in warped financial incentives in firms and associated risk management, culture, and conduct deficits? So can I kick off with Ranjit with that one?
Thanks, Ashley. Well, I think, it's a very very pertinent question. I think I've shared David's views around corporate governance and issues. First of all, I think there is definitely on the question of whether the system has become safer. I think undoubtedly the system has become safer. But has the system become safe? I think the answer to that is probably not. We are not assured that we've been able to reach a stage where we are able to avoid the next crisis or predict the likelihood of the next crisis. In other words, likelihood maximization. In other words, ensuring that we are able to identify this. We need to strengthen a lot more efforts along those lines, actually, Ashley. Impact minimization, I think we've begun to address it. So the question of have we addressed the crux of the problem, I would not be so cynical. I think some of the reforms that have come through from the G20 have certainly begun to address some of the crisis issues that had surfaced. But the danger that we have as regulators is that we do not want to be in a position where we are simply addressing or consumed in fighting the last war. I think we need to go much deeper than that. And one of the things that I think strikes me, that we have to be very careful about is to be, to see what is the long-term impact of some of the reforms. And I would go back, given the fact that, many of us here have experienced the Asian financial crisis, and look at the Asian financial crisis. In fact, some of the work that we talked about on systemic stability, I can tell you was, at the forefront of discussions in 97, 98. But when those discussions were emanating from those of us in Asia and said, look, it's important, even in Hong Kong, to address issues of systemic stability, etc., the response at the global regulatory level was, no, this is an Asian phenomenon, right? This is an emerging market phenomenon. And it took 10 years for the global financial crisis to drive home the message that systemic stability was an important part of the objectives and principles of IOSCO. So in a way, it is very important that we begin to be able to pick up this, and you said here, addressing the symptoms, Ashley, identify where there could be leading indicators occurring in different parts of the marketplace. Similarly, on corporate governance. Now, your question ultimately, I think, is about, is this deeper than regulation? I think the answer to that is yes. I think ultimately, as regulators, we can, the solution is not about having greater and more thicker rule books. I think the solution really is understanding what drives incentives, what drives behavior, and corporate governance is about that as well. But I dare say that if you take the corporate governance solution and think about it as purely a code of corporate governance that's being put out there, a box-ticking approach, you'll fail there as well. Because inherently, what you're talking about is a culture of governance. And I don't think the regulators should be sitting in boardrooms. I don't think that's the case at all. I think it is really a case whereby you want to be able to ensure that the culture of governance, the culture of ethics that drives behavior at the firm level, is addressing the right sort of motivation. I know IOSCO has begun to do work in this area, and I think to give credit to the position that we have taken at the global level, a lot more insights from behavioral finance are being brought into regulation, but a lot of that actually is targeted towards investor behavior. I think we need to start thinking a lot more about firm behavior and what drives that. So if I looked at your, the point, I think definitely, we need to go deeper. We need to start focusing on this issue, because I think what has really been very apparent is that there is a tremendous myopia within financial markets, and we have to address that. And that is ultimately the crux of the point that people are beginning to say, where is the sustainability element coming in? Where is the inclusiveness element coming in? Look at the concentration of wealth that's beginning to appear around the world, and look at the amount of people who are still struggling in many instances, given the developments that we've had. Has the market's growth been able to provide a much more dispersed wealth generation? These are issues, I think, fundamentally that we have to go back to. These are the kind of issues I would say are the crux of the issue: sustainability, inclusiveness, ethics, and rebuilding what has sadly disappeared in finance today is the trust and confidence. And we need to put a lot more effort in working together with the industry. It's not something that regulators can do. It's really something that collectively we should focus our minds on, is how do you regain back the trust and confidence. And it's interesting, looking at this issue, I was just seeing how, in a sense, the financial services industry is seen by many. It may be a perception, but nevertheless, it's the perception that we must address. People see the financial services industry as being hardwired to serve itself first and the needs of its users second. And it's the statistic that was run by the Economics Intelligence Unit illustrates this point, where a survey of almost 400 financial services executives found that almost 60% view the industry's current reputation for ethical conduct in a very positive light. In contrast, the survey of the general public found that the financial services industry is the least trusted to do the right thing. And these are the kind of issues that I think we should tackle together, both regulators, policymakers, and the industry.
Thank you. Can I pass that over to Doug?
I think some very good points there. I would say that at least the financial services industry in those surveys is still coming in as slightly more trusted than politicians. So we're not necessarily we're not necessarily at the very bottom, but I think that's a very important point. And I think looking at this, there are a number of issues, and really in looking at this, normally at this point we would be asking, have we put in place the framework for the next crisis? But actually what we are just asking is, have we even put in the framework that would have prevented the last crisis? And the short answer, and I think David made this very clear, is actually we haven't even put in the framework that would have prevented the last crisis. And on some of those areas, I think we have to realize that an amazing amount has been done, that it's not just the symptoms, that if we look at the root causes, some of the root causes were over-complexity, a lack of understanding on the part of regulators, on the part of financial institution management, on the part of shareholders, of the products, of the institutions, of the markets. And so by trying to make these markets more transparent, to make the plumbing of those markets work better, this is a major focus on the causes and not only the symptoms. But at the same time, if one thinks that really at the depth of the global crisis was this problem of globally, systemically important financial institutions and the need to be able to resolve when they're in distress, no, we're not to that point. And I don't think that it's something that we're going to get to in the near future. And it's something that really brings to light a couple of the points, particularly arising from OTC derivatives, and that is that our view from both a policy side and from a financial side of globalized markets is different. In other words, certain aspects of markets were probably not going to be able to come to global solutions. In others, in OTC derivatives, the fact that we've got, if you will, the base agreement, the consequential issues will eventually be resolvable. But in some areas, that's not necessarily the case. Now, what I think is interesting if we look at this question from the bigger perspective is that going into, and if we look back at 2005, 2006, I would say that regulators, financial institution management, certainly academia, thought we had a very solid framework of understanding how markets work and how we should be dealing with those issues. What I think this crisis has done is it has blown some major holes in what was a universally, almost universally agreed framework for understanding markets. And at this point in time, I think regulators are very much trying to come to grips with dealing with a world where they no longer have a universally agreed framework for understanding what they're doing. And this, from the standpoint of dealing with the crisis, is one of the biggest problems. And certainly some things that we never would have talked about sort of generally pre-crisis that are now widely acceptable, things like behavior of market participants. Market failures we would have looked at, but in a shareholder value context, we wouldn't have thought about the wider public interest, which has become a much bigger element. And I think it takes me to my final point, which is that when we're looking at this, we need to come back to the basic idea, which is that financial markets are there to support the functioning of the real economy. And that to the extent that financial markets are not supporting the growth of the economy, the development of society, then that is a serious problem. And when we're looking at regulation, we need to be coming back to first principles and building up from there.
Thanks, Doug. Just picking up 2 points that you made there. Firstly, is the financial crisis as an opportunity to explode some myths and to ask questions that frankly couldn't have been asked beforehand, because if you'd asked them, those in the room in which you were raising the question would look at you and think you were stupid. And you weren't allowed to ask these questions. So that's been a very beneficial thing. One of the myths, I wouldn't say it's a myth, but one of the assumptions which regulators, particularly securities regulators, took virtually as holy writ was a theory of disclosure. Now that is one that is under extreme examination now. And putting it in very, very simple terms, the realization is, and it should have been realized beforehand, that ordinary investors, what often one terms retail investors, by and large don't read it. So you end up trying to work out, okay, what is its function? Is its function more to do with the protection of those issuing a disclosure document so far as potential liability is concerned? Or is it for something else? What it may not be to do with is actually educating the apparent reader, the potential investor. So there's a lot of work going on around that, and this gets back to the sort of behavioral economics work. The other point, the last point you made, Doug, we had the Asia Pacific Regional Committee of IOSCO meeting in Hong Kong yesterday. We had a few industry participants in the morning who were basically talking about the future of finance in Asia. And they're all at one in saying, they came from buy side and sell side, but they're all at one in saying the infrastructure hole in Asia is absolutely massive. It cannot be filled by traditional bank finance for all sorts of good reasons. It has to be filled by market finance through capital markets. It runs at, I think the number was $747 billion US dollars a year. And in order to fill that hole, you need to deal with, I think, something that both Ranjit and Doug have dealt with, which is the apparent trust deficit. Though I think I remember that survey, the most trusted industry was IT, which I found a bit peculiar, but there we go. But basically the point was, to use the capital markets to connect finance through markets to real economy issues like that infrastructure whole is absolutely key. And finally, I'd just say there was a report that I think in its diagnosis was very interesting. I think it was now the year before last, written by John Kay in the UK, which is all about short-termism and long-termism in equity markets in the UK. But basically, it was a very, very good diagnosis, I think, of the way, at least in the UK, the financial world, whether it's asset managers or whether it's sell side, had become disassociated from the businesses and the economies which they were helping others to invest in via them. And I do recommend those who haven't looked at that report, look at it. You can find it on, I think, on the UK government website. Right, okay, well, thank you very much for those remarks. I'm going to move to the next question now, which is about this issue, which, again, seems a little academic, but I can tell you it's real, and it takes up an enormous amount of time for the global regulators, which is this question of extraterritoriality. And what I'm going to ask is this, is what is the Asian, and as David is here, the non-Asian perspective on extraterritoriality, and in particular about apparent concerns in the US and Europe about the potential for Asian regulatory arbitrage and problems with cross-border coordination. And what this is really about is there a potential for these G20 reforms and the other reforms to address the financial crisis to backfire by fragmenting markets around the world and further reducing cross-border liquidity, which means that infrastructure hole in Asia will be even harder to fill. So can I kick off with David on this one, please?
Well, let me give you a non-Asian view, perhaps a more general view, which is that today we have two big sharks in the pond, and they draw up their rules, and they basically say, you abide by our rules or you're not doing any business with the United States or the European Union. So effectively, the rest of the world is a regulatory taker. That's the situation. Not very fair. And here's the problem as I see it. When we fast forward 10, 20 years and we have many more big markets, what is going to stop China, Brazil, India, Indonesia or other doing exactly the same? You want to do business with us? Here's our rule book. And so that situation has got to be dealt with. We have to build, as I said earlier, a framework, institutional or practical, that will help us move towards convergent standards. It's more complicated than that because equivalence requirements in Europe is not the same approach as substituted compliance in the United States. It might be helpful if it was, but it's not. Here's another problem. Whoever goes first after a slogging through their legislative and political systems is not going to change their rules once they're applied. So again, if you don't have a symmetric timing of political decision-making or legislative decision-making, you're going to have the sort of first mover advantage for whoever gets in there with their OTC derivative rules or whatever. So this is really not satisfactory. And I think, as I said earlier, I think we've got to, and this is partially the work of Ashley Elder's task force for IOSCO, but it is also thinking about how do we get that convergence? Is it going to happen by all of us agreeing in a non-binding, informal way, and that's the institutional framework we have today? Or is it going to require something more? Is it going to require some form of dispute settlement, some form of sanctioning regime? All this is very new and difficult thinking. But I think we've got to do that because the world is going to become more complex. It's not going to become less complex, it's going to become more complex. So those are sort of the framework remarks that I have here. So we're trying to bolt systems together. If we don't work together at the same time, in the same time frame, we're going to have an awful job of trying to make the global financial system function without regulatory friction and unnecessary costs for firms.
Thanks very much. Can I pass that one over to Greg for your views? I know that Greg has been in the thick of this, not only as chair of IOSCO, but also with the sort of unusual position of Australia being part of Asia Pacific and looking at it from that angle.
Sure. Look, I think there is a real risk of contraction of capital flows as a result of some of these initiatives. And I mean, clearly, as a result of the crisis, mainly I expect, there has been into G20 countries. I think there was a report by McKinsey last year, which actually identified the capital inflows into G20 countries in 2007 was about 18%. Crisis, etc., that had dropped down as low as 4% of GDP last year. So we've already had a massive drop in capital flows, and that's outside of what's happened with emerging markets recently. It's been going out. So we all know that basically, the free flow of capital is actually a very important aspect of funding economic growth. So I do think we need to be careful. I think that in terms of, some of these regulatory reforms, I think it's where IOSCO has a very important role to play, because if you think about it, as Ashley said, market-based financing is clearly going to be critical to funding economic growth in the coming decades. We know that the banking system, particularly with some of the changes, its capacity to fund economic growth is diminished and will probably continue to be diminished. So basically, to what David was saying, I think it puts into front and centre, it is so important for us to really develop a global rule book going forward. And, basically countries outside of Europe and EU, they actually don't necessarily want, many countries don't want an EU approach or an American approach. What they actually want is a global approach. So it actually means that we need to have, and which we do at ASCO, we need to make sure we have rules that are sufficiently granular enough to facilitate mutual recognition. Because when you think about it, basically security regulators collectively, we have basically common objectives, which is investor protection, fair, orderly and transparent markets, and trying to mitigate systemic risks. So global standards. Secondly is equivalence. As I said, that is absolutely critical, and the work we're hoping from Ashley's task force is going to be very important. And it's not just, at the moment, there's been a lot of focus on OTC derivatives, but there's just an enormous amount of work to be done in this area in terms of how we can cooperate together, whether it be in bond markets, whether it be in equity markets, whether it be in client monies for those who may have been affected. So I think that there's a big job, and in funds management to mention, I think about Asian Funds Passport. So I do think in the area of actually seeking to rely on one another, I think we're actually looking at a number of years' work to try and really work cooperatively and rely on one of those as regulators. And the third thing, and I think that's very important as part of that reliance, is supervisory cooperation. And I think this will become front and centre. Rather than just simply bilateral MOUs on how we cooperate together, what I would like to see is in ASCO, we have a document called the IOSCO MMOU on enforcement, which is really the way in which we enforce between ourselves around the world. I would really hope over the next few years that we can extend that to an MMOU on supervisory cooperation so that we can go that one step further. Because really when you think about it, globalization is a fact of life. And we all know that we've really got to think more global and act more local and in a consistent fashion. So that's my comment. Just an added comment, I think the other thing of all of this is I do think clearly we need to move to a thinking more about, I think that balanced stability versus growth. Certainly in my mind, I think we've got to push it back towards growth. We've focused on stability the last 5 years. I do think that growth is the one that balance, I think, needs to be shifting perhaps the other way a lot more actually. And I'd encourage other part of all this is really encourage industry. I'm actually quite a big supporter of industry self-regulation, and frankly, industry can make the work of regulators a lot easier by actually focusing on their own problems and actually trying to identify them a lot earlier, which actually means that in fact you don't end up with unintended consequences. And I think that that's always important, but I would stress that is something that industry needs to focus on a lot more. And even thinking about behavioural economics if you're dealing with retail investors.
Thanks, Greg. Just picking up on something that David mentioned about the two big sharks in the pond at the moment, which is Europe and the US. A document was published not very long ago, I think it was the end of last year, which is by the Atlantic Council, which is basically an organization to promote dialogue between the two sharks. And it was about the transatlantic financial reform and the G20 agenda. And there's quite a lot of, even now, disputes, largely about details, but important details about the implementation of financial reforms. But I thought there's two very interesting statements in this document. The first of which was that they realized, and I actually think for the first time in those two big jurisdictions, and I'll quote this, they say that the transatlantic regulatory alliance is no longer the only game in what has become a truly global town. Then it talks about the fact that in 2013, 3 of the 15 largest banks in the world are Chinese, 60% of the world IPOs are taking place in China and other emerging markets. The equity markets for the BRIC countries are already half the size of the US equity markets, and so on. And then they go on to say that as transactions have moved to ever diverse parts of the world, that's, I think, code for mainly Asia, so has regulatory influence. And in a world with more diffuse power and economic growth, closer coordination between the US and the EU is necessary to send more consistent messages. And there's a slightly sinister paragraph, which is, going forward, it is increasingly likely that only when the United States and the European Union are able to act in unison will they be well positioned to export their policy preferences, which I thought was quite an interesting characterization. Now, we had the APRC, the Asia Pacific Regional Committee meeting of IOSCO here yesterday. The big theme in that was actually there are many jurisdictions within Asia which is massively diverse that are very different to the conditions that you find in the US and the EU. And our task, which I don't think has been addressed properly to date, is to articulate what those genuine differences are and explain why the export of policy preferences cooked up in the United States and the EU may well not be appropriate and in fact may be quite destructive. And that was the sort of the overarching theme of our meeting yesterday. Now, what I'd like to do now is move on to, I think, the big question. I'm going to pose this, and if you keep your answers fairly short for this one, if you can, which is this: the next crisis, how do we identify it? That's about data and information, I think, but one or two other things, and possibly a large dose of imagination. How do we prevent it? And if we can't prevent it, how do we address it? So can I kick off with, I think, Greg to start off with, and I'm going to move to Ranjit and just down the table.
Look, I think it's very easy. I do, as I said, I think you've got to focus on emerging risks and what's coming down here. And I think actually that's why IOSCO has now a committee on emerging risk, and I think many regulators now have a committee on emerging risk to basically, you can't stand still anymore. I mean, basically it's a dynamic world and you've got to identify what's coming down at you and react. So for example, I think we've taken action quickly on what happened on LIBOR. We set up standards which are now being looked at as the reference point. We quickly are now looking at crowdfunding as an area that is coming down and looking at what we can do there. We are looking at, we recently had a discussion about cybercrime and what we think where that could attack us, and perhaps strengthening risk management. And also social media. I mean, let's face it, to what Ashley said before, I mean, basically, we're into an online environment. Basically, people will buy financial products on their iPhone in the future. We know they already do. So we've got to think about how we can change and adapt and make sure we reduce risk. So I do think being, if you want to be an effective regulator, you need to be proactive and you need to be forward-looking. And I think that's it. And it's really, I think that's the key to trying to mitigate against future crises.
Thanks, Greg. Ranjit?
Oh, that's such a loaded question,
what's
isn't
the
it,
next
Ashley? where it's coming. I think a lot of the work that we are doing in the area of systemic risk surveillance is very important. I think this particular effort and this conversation that's happening in the last maybe 5 years or so, where there's been a lot more focus on the part of regulators to start looking at risk assessments. I mean, IOSCO, for example, has just published a few months ago its risk outlook, and that's the first time. Not only does it have a disciplined process of risk assessments being done internally, and we know this through all the work that we do in the various committees of IOSCO, but more importantly, we're putting ourselves publicly accountable to the risk assessments that are taking place, and that's an important step. I think more of that sort of assessments, more risk assessments, surveillance, systemic risk surveillance work, looking at risk vulnerabilities, the kind of dialogues that we're having with industry at every major meeting of IOSCO, focusing around what are perceived to be issues of the day. That, I think, is going to help a lot more in terms of at least trying to identify. I don't think we can underwrite and say we've got the crisis covered, but what are the kind of risks that are emanating itself. And if I may just touch a little bit from an emerging market perspective, Ashley. I think, an emerging market, the committee that I chair of about 90 jurisdictions, is a massively challenging task because there are different levels with some of the largest capital markets in the world in that grouping to the frontier markets. And I think ultimately 3 issues come in terms of strengthening their own resilience. The first of all is there must be a lot more focus in terms of structural reforms. and building up institutional capability. For instance, if you see the kind of effects of the volatility that happens in capital flows, you're able to differentiate emerging markets that have a strong domestic institutional capacity. And even, you know, at the tapering effects that happened last year, you can see the differences that are occurring. So addressing domestic structural issues are very, very important in terms of preventing some of the crisis effects. The second issue for them really is to be able to start addressing a point that I think, you know, we've all talked about, and that is stronger supervisory cooperation. And this is extremely helpful in terms of being able to identify cross-border effects. So that's, I think, another critical issue. The third one, of course, is to raise capacity. So capacity building in many of the emerging markets are very, very critical. Capacity building in terms of surveillance capabilities, enforcement, the whole slew of areas. And these are the kind of areas that we should be able to also focus on. So 3 dimensions, if you like: more, you know, closer, granular risk assessments, capacity building, and cooperative arrangements. I think this is what needs to be a focus for the emerging markets, actually.
Thanks, Ranjit. Well, very briefly, actually, I think we need far better data. I think on my right here are 3 of the leading securities regulators in the world. They should be able to have real-time data on any firm or their exposures immediately. We're a long, long way away from that. So improved data, improved understanding of financial markets. I think it was Gillian Tett in the Financial Times who said we spend more on polar research than we do on understanding the world financial system. This simply doesn't make any sense. It's work for our academic community as well. I would pay much more attention, and I would have a laser-like focus on property markets. Most crises, in one way or another, come through the property markets, if you look at history. I don't think we pay enough attention to the dynamics of the property market, whether it's commercial or retail property. And my final point is, I do think there is a utility of good macroprudential analysis, and I think the authorities have simply got to take measures early. And I don't mind too much, frankly, if they get it wrong from time to time. Because I'm thinking at the back of my mind, I prefer to get it a bit wrong than have another 15% of GDP wasted.
Yes, I think I agree with most of these. I'd actually just like to hit off on 2 points. The first is embedded in this is one of those philosophical changes. The idea that financial crises are a characteristic of a market-based financial system. So if we're going to have a market-based financial system, we have to understand that periodically we're going to have crises, and that means that we have to assume that we can't prevent them all, and that we have to put in place the preparations to deal with them when they do happen. And this comes back to a point that Ranjit made, and that is we can have a safer financial system, but if you have a safe financial system, then that financial system is not actually doing its function in allocating risk and supporting the economy. So our objective is not to have a perfectly safe financial system. If our financial system is perfectly safe, it won't actually function for what we need it to do. And I think coming back to David's point, and I think it's a key one, we will never be able to predict the exact nature of the next crisis. I think it's a great exercise to be thinking about it. I think that the work being done on macroprudential supervision is extremely important, but we're never always going to get it right. At the same time, the key is that we do know that there are certain types of crises that we see over and over and over again. Property market crises. If we look at pyramid schemes, we see fraud in markets. These are the sorts of things that you know will happen over and over, and you need to have systems in place to deal with it when they do happen.
Very wise. Sorry.
If I just pick up on a comment that Douglas just made, I think it was a very, very important one. And that is the idea about, not to impose that degree of regulation that you have an impact on the very raison d'etre of capital markets. I think this is a real danger, because the fact really is, it is, after all, the marketplace is a market for risk capital. And too much conservatism will have a major impact on that part of it. And this is where I think we need to be able to have a much more balanced debate on stability as well at the global level. But this is something that I think has to be taken up, David, at a much wider context.
Totally agree.
Yeah, if it's of any comfort that those in the room, in fact all of you will be in some way connected with the financial markets, there is a continuing sort of debate within the sort of regulatory community about the danger of getting to the stability of the graveyard. So it's, I think all those points are well taken, as well as Douglas's, is that there will be future crises, and we can kind of look at the shape of these. Now, we've got only about 10 minutes left. I just wanted, I think, very briefly, I think just to talk, to ask Greg and Ranjit to comment on the future of regional collaboration in Asia, to articulate the Asia viewpoint on global reforms, which I personally think is incredibly important, but I welcome your views.
Sure. Look, at one point, I think, and to use your words, I think, as you often say, I think Asia needs to learn to speak more as one voice. I think to mitigate against the Atlantic partners. So I think that is really important, and we saw that recently out of the APRC, which is led by Ashley, on the CFTC, where in fact we actually pushed and we got some relief in terms of the implementation of transactions until July last year, and so there's been proactivity of the Asian voice. Also with the EU in terms of the applying of equivalence to CCP. So I think there's been some very good examples where I think, and not only actually doing it, but basically they do listen. So we can speak as one voice, and they do listen. And I think that is actually quite important. In terms of Asia going forward, from a regulatory perspective, as I said before, when you think about, I think what David said before about the real economy and the challenges that Asia faces, I think that we have a really important role to play in terms of really trying to assist the real economy, and particularly with market-based financing. So I do think, we probably need to be thinking about how we can develop strategies to facilitate infrastructure, capital markets, SME capital markets, which clearly can contribute to creating jobs and adding to the real economy in Asia. So I do think that there is, I think there's a lot, I think now that has been done, and I think there's a lot to be done.
Ranjit?
I think actually the focus of strengthening the Asian voice, as we've discussed many times, is very critical. And we have to do that, otherwise you run the real risk of fragmentation of global regulation, actually, David. And so whilst Asia is on the table in a lot of the regulatory fora itself, and very influential in terms of the presence itself, but the articulation of the Asian voice is not as strong as it ought to be. But I'm encouraged. I'm encouraged by the efforts that are being put in, including the discussions that we had yesterday, in terms of creating a more cohesive picture on the Asian voice. There is clearly going to be a very wide dispersion in terms of jurisdictions within Asia, unlike obviously in Europe. Of course, US is particularly one or two. But the reality is, to kind of get that cohesiveness in the Asian voice is absolutely critical in terms of global regulatory position. And so initiatives that are happening at the APRC level, we've set up now the Takeovers Forum with SFC and the Securities Commission Malaysia, where we've got takeover regulators together sharing viewpoints. We've got a market surveillance one that Malaysia is doing with ASIC and many other members of the APRC. Again, it brings a commonality in terms of voice. And if I could look at the examples of what's happening in ASEAN, where the ASEAN regulators are focused obviously towards the ASEAN Economic Community, AEC, objectives of 2015. And people have often asked me, is this going to be an achievable target in terms of one market? My viewpoint is, of course, there are still challenges ahead. So far, we've had several jurisdictions that have signed on at the ASEAN level. But more importantly is the commitment towards the path of getting the common voice. I think that is really what we need to see strengthen a lot more here.
very shortly, because I don't feel I'm qualified to talk about this, but I think having spent most of my life in Europe, I'm very struck when I come to Asia that the first thing that, when we talk about regional collaboration, is everybody says, oh, we're all so different. Well, why don't we start from the premise, let's work out what our common interests are. Jacques Delors, who was the great president of the European Commission, used to ask two questions. He said, what are our common interests, and what is the level of our ambition? And I do think it is absolutely essential that there is a stronger Asian-Pacific voice in global financial regulation. Now, I think that's absolutely vital for global balance, for the quality of outcomes, and for ensuring convergence that Greg and Ranjit were talking about. And I think yesterday's meeting, which was so well chaired by you, Ashley, started to begin to identify common interests on enforcement, common interests on building data, common interests on seconding people from one jurisdiction to another. As Greg says, when you join a regulator, you join a global and Asian regulatory community. Cooperation on capacity building. So actually, I think building step by step like that, building this common Asian voice, as you described it yesterday, is awfully important. And I really think there's a lot to be done and a lot of fruitful benefits for everybody.
Thank you, David. I think actually, just reflecting on that, I think one of the issues in Asia is that we are a little bit focused on the degree of competition between jurisdictions in Asia. And one thing we learned yesterday and discussed is that if we work together, the available size of sheer growth, the infrastructure number I mentioned earlier on and such like, means that the size of the pie available to all, if we collaborate, is far greater than that we would achieve by competing too much. And that was a sort of recognition throughout the meeting, I think. Right, look, I'm on a strict timer. I've got an iPad with a timer which now shows 2:58. Now, I've got a few questions. I'm actually going to pick one, and I'm going to direct this for very quick answers, to Greg, Ranjit, and possibly David, if you want to intervene, is this: are regulators adequately equipped and resourced to regulate in light of the volume and complexity of new regulation? Now, how about Ajit?
Well, I always respond to that when I'm in the Senate, that basically you pay for what you get in life, and you can have an ASIC at 350, 450, it's your choice, and you have to decide upon the level of resilience you want in your financial system. And I do think resourcing is always a challenge, but then again, you really look at the priorities, and we look at things on a risk-based approach. And but I do think it is really it's a policy issue as to how it's approached. I'm also, though, quite a big fan of user pays. I think that regulation really, it's back to my view about self-regulation. Basically, if an industry is really well self-regulated and we don't need to be spending as much time there, then that particular sector should pay less for its regulation. So therefore, I think it sort of is a system that drives, in my view, more efficient regulation. So I do think it is a lot more about being a lot smarter about regulation, I think, going forward, frankly. So, so I do think that's sort of a part of an answer to what you're asking.
Ranjit?
I think the short answer is no. I think you definitely need to be able to get them to have, there must be greater capacity itself, actually. I think fortunately in some cases, certainly in the case of Malaysia, we are well funded, but the challenge really is to get the skill sets to come in, and the reality also really is that the markets are becoming increasingly complex. And this is, I think, an issue that we have to put together at the highest level. I agree with Greg. It's government, it's overall focus on strengthening regulatory capability. But I look at some of the issues that we've talked about and think about the global issue. David alluded to capability in surveillance, etc. And I see the acute shortage of resource capability at IOSCO. the kind of objectives that are being set for global regulators today in addressing some of the issues that we talked about for the past hour and 10 minutes requires tremendous resource capability, and that's just not there. And so we've got to find a way to address that.
Yeah.
Just perhaps a thought from the global regulatory perspective, and I very much agree with what both Greg and Ranjit said. There are quite a few banks in the world that have got 100,000 employees or more. If I calculate the Financial Stability Board or IOSCO's percentage against 100,000, we have 0.025%. 25 people roughly. Now, if we believe in global capital markets, and I think most people in this room would surely do so, we are just going to have to put a few more resources to try and make it work. And the benefits of that, the cost benefits of that, I'm very happy to do a cost-benefit analysis of that. So 0.025% of a firm, that's the share of resources of a firm that has 100,000 employees. That's what we're dealing with.
Thank you. Well,
I'll actually just add one thing.
Donation boxes
I actually think it's always this idea that regulators are behind the market. And I actually think that that's something that regulators should use to your advantage. In other words, if the markets can't make the simple regulators understand what they're doing, there's a real question about the value of what is being done. In other words, if it's not something that someone with a university degree and a reasonable amount of experience can understand, then there's an issue there.
I think that's a great note to end on. So, as Greg said, the donation box will be at the entrance. Thank you very much to all our panelists. That was, in my view, a great session, and please just to extend your thanks to them. Thank you very much.